Our founder, Jim McBride, has often said if he had to do it all over again, he would be a psychiatrist first and then an investment advisor. Understanding exactly how people make investment decisions and respond to the ups and downs in the stock market would make him a much better advisor. Unfortunately, when it comes to investing, people are often their own worst enemies. Biases often influence decisions, and not in a good way. Overconfidence. We all know the story of asking a group of people, "How many of you are above average drivers?" Usually, 80 to 90% of the folds raise their hands. Statistically impossible, but understandable, because no one thinks they're below average. That is overconfidence, and it can often lead to investment decisions that are riskier than we think. After all, if we think we are right and we are smarter than most folks, what could possibly go wrong? Hindsight. This is our favorite. We refer to it as betting on instant replay. Take investing in Apple, the largest U.S. tech company. Many people have said, "I knew Apple would be a spectacular investment." Really? In January 1981, Apple was trading at 13 cents per split-adjusted share. 20 years later, June 2001, it was trading at 37 cents a share. For 2 decades, Apple's price chart looked like the EKG of a dead man. But later that year, Steve Jobs introduced the iPod, and the rest is history. Amazing how many people knew that was the turning point. Confirmation bias. People believe what confirms what they believe. It has long been known that folks read and listen to the opinions of those they agree with. We inherently ignore opinions and even facts that contradict our beliefs. Not a good way to make objective decisions. And as hard as it is for people to accept, the stock market does not care what you think or what you own. Framing. How information is presented is called framing. When Oklahoma Senator James Inhofe brought a snowball on the Senate floor in February 2015 in response to reports that 2014 was the warmest year on record. He tossed the snowball to the Senate president before saying that environmentalists keep talking about global warming, even though it keeps getting cold. Now that is framing. In fact, 2014 was one of the 10 warmest years in history up to that point. Herd mentality. Your mother told you more than once, just because Joey jumps off a cliff does not mean you should too. Your mother knew Joey was an idiot. Unfortunately, following others is powerful. A good example of the herd mentality is FOMO, the fear of missing out. The dot-com bubble is a particularly painful example. In the late 90s, if the investment said internet, people bought it irrespective of earnings, capital, competition, and so on. Many people buying right up until the NASDAQ crashed in March 2000. It took the average 14 years to recover. Loss aversion. With a late lead in a football game, many coaches often start playing not to lose. It is called the prevent defense. Don Meredith, the old Dallas Cowboys quarterback, often said the only thing a prevent defense does is prevent winning. Loss aversion is when investors are so afraid of losing that they act in ways that hinder winning. Sometimes losses must be admitted and taken. Not easy. So, if you're looking for guidance in successful investing, we have a friend named Lucy who can help you.